Headstart basically is the largest volunteer-driven organization. We are a startup community based out of Bangalore. Headstart was started around 15 years back, and till date, on this date, we are present in more than 30 cities of India, and we also have chapters outside India. So we have started in 3 other parts outside India as well. We have many initiatives that we do at Headstart. One of them being the Investor Circle. So Headstart Investor Circle aims at making availability of angel funds for early stage startups, and also enabling the angel investors who are aspiring angel investors or who have just started their journey to get good deals across the table. At Headstart Investor Circle, we have also started investing in startups. So far, we have made more than 5 investments in startups like Bonviero, Cora, etc. And we are growing our network. That's one. Other than that, we have another initiative of Headstart, which is Headstart Hubs, which is a curated network and an entire community of incubators and accelerators that help early stage startups. We also have Headstart Boosters, wherein we have services and tools that we give to early stage startups that can help them in growing faster. We also have niche digital communities present, we have communities on SaaS, we have communities on D2C. So we have entire digital communities of this sector specific startups, and wherein all the founders can interact among themselves and interact and learn, basically synergies they can explore out of that. For today, from the Headstart Investor Circle, we do such sessions almost once a month. And for today's session, the topic is kickstarting your angel investment. For that, I'd like to invite Mr. Aditya Arora. He's the CEO of FAAD Network Private Limited. I'll give you a short brief. He is, like I said, he's a CEO at FAAD and is an angel investor in more than 20 plus startups. Some of the notable startups that he has been an investor in includes BlueSmart, Vedantu, Grib Invest, and many more. FAAD is basically a network of angel investors. They have a community of more than 1,300 plus angel investors, and has made more than 55 odd angel investments through the network. Apart from FAAD, Aditya is also present. He's also a member at FICCI and CIIE, and was also a mentor at Atal Innovation Center when Niti Aayog was established. I'd like to invite Mr. Aditya Arora. He'll give you a short brief on himself and FAAD.
Got it. Thanks a lot, Rucha, for that kind and warm introduction. Greetings to everyone who's joined in the session. So yeah, I think Rucha has covered it all well about more of the background. But for us, the idea is to invest in young, exciting entrepreneurs, because I also started my journey very young. So we look at businesses which have a potential to scale and also uses technology and an unreal knowledge in the beginning to adopt to the mass market. So yeah, pretty much I think that is there. So I think more of that we can cover in the rest of the session.
Yeah, thank you so much, Aditya. Let's just start with a very basic question. What, according to you, is angel investment, and who is an angel investor?
Got it. So I'll break it down into 2 parts. One is, of course, what is angel investment? So angel investment is, of course, picking up early stage, high risk companies and investing in them, probably being the first or the second investor that they can get. And then, of course, also helping them through your mentorship, through your advisory, so that they can grow to the next level and raise further larger rounds from venture capitalists. You may have heard of some of them like Sequoia, Tiger Global, Lightspeed, right? So likes of those. So angel investment comes as the first or the second investor in any startup, right? So that is an angel investment. And it can be in multiple sectors, it can be in one sector, it can have different ways and approach according to the taste and preferences of the investor. What is and who is an angel investor? Again, as I'll cover this as per SEBI's guideline, which we refer to. So in SEBI's guideline, it's written that the minimum net worth of an angel investor per se should be around 2 CR, excluding their primary residence, which is their home. And apart from that, if they should also have some level of early stage investment experience, be it in some early stage fund or be it some as maybe investor in somewhere else, where you have looked at a slew of early stage companies and have invested into. Or if let's say you haven't, then the second definition is that you should have at least 10 years of experience as a senior corporate professional in an organization. So as per the definition, this is as per SEBI's guideline, but a more practical, of course, apart from the bookish definition, a more on the ground definition is an angel investor is someone who takes unparalleled amount of risk at an early stage in the hope of course, a return, and helps the startup to go to the next level through his mentorship, connects, advisory, and what.
Great, got it. So when you say that it helps a startup to go to the next level, can you explain us what are the stages of the entire journey of a startup in terms of fundraising, starting from friends or family round, then the angel round, then VC, PE. So, people understand that at what point does the angel investor come in?
Perfect. I'll explain this through a story. I've got a good story to explain this. So imagine you basically want to plant a tree, right? Now you can't just go ahead and plant a tree from day one because tree has also got a process through which it grows. So on the day 0 or day 1, you go ahead and buy seeds, right? You buy equipments, you buy irrigation facility, you buy all that sprinkler, you buy all of the facilities so that you can of course sow a seed, right? Now you sow a seed, right? When you sow a seed, typically the people who are helping you are your friends, your family, right? So they are basically helping you to achieve your goal, right? So this is where a friends and family round come in. Then you typically have nothing. You haven't even planted a seed. You are in the process of planting a seed. You go to your friends and family and they are putting money not on the final tree. They are putting money on you, right? So essentially that's the confidence with which they grow. Now you nurture the plant, right? You cherish it with water, you give it some sunshine and all that. And of course, after that, it goes into a small sapling. Now in that small sapling, now since that visibility is there above the ground, seed was planted below the ground, nothing was visible above the ground. Now sapling has come, so there is some visibility above the ground, but it is just less. It's not too much, it's very less. Now let's say a neighbor of yours looks at the sapling and gets interested that I want to help, right? Now that neighbor in this example becomes an angel investor because they are seeing some level of traction above the ground or above the base, and they have an expectation that the sapling will grow into a tree, right? So they basically join you and help you. They basically become the helping hand of yours, helps you get more good quality resources, helps you get good quality seeds, helps you get more good quality sprinklers, right? And they basically take up, again, they are taking a trust on you and a bit on the sapling that's grown above the ground. Now you nurture it more, right? And that sapling goes to a very, very mid-sized plant, right? Very, very mid-sized plant, where of course, you can see that now it's almost double or triple of its size above the ground. And now let's say more people are viewing it, right? When more people are viewing it, they further get interested that, oh, wow, this is something amazing and exciting. And typically I would want to grow this 2 or 3 times size plant into a larger tree. So these becomes your venture capitalists. These becomes your, of course, early stage, later stage investors, right? And they basically help you take that 2-3 sized mid-sized plant to a larger tree. Now, once that mid-sized plant, let's say, goes to a larger tree, you have more capital now because they have more people who are willing to contribute, put in bits and pieces into getting more sun, into getting more good quality equipment, good quality seeds, good quality facilities, right? So good quality soil. So all of that helps you grow the plant. Now the plant is now a tree, right? Once it is a tree, right? Now on the tree, basically the next step is the fruits start to come. But before the fruit starts to come in, you need to have good quality maintenance of the tree, because if the tree is not maintained, fruits will not grow on that. So that is where later stage private equity investors and all that come in, who basically help you grow that plant into a tree, not who help you get fruits on that tree. Once the fruits start to come in is when the company goes public, because now the fruits can be eaten by anyone, right? Anyone can come in, even if you're not there on the plant, and anyone can eat that. So this is the whole hierarchy. The reason I told you is to understand the whole spectrum, because an angel investor would come in on, let's say, a day 2, right? Day 1 would be maybe a friends and family, but there are further series of investors beyond angel investors as well who continue to support the startup. And typically the angel investor may not be at the time when the fruits have started to come in or when the plant has become a tree, but if the angel investor did not come in at day 2, the plant would have never been. So,
right. Very nicely explained. When you say that, angel investor comes in on the day 2 and they don't have a very good idea about how the tree is going to grow, right? But they have seen a very early traction. They've seen just the plant growing from the base. So at what stage do you think angel investor thinks to invest in the startup? What do they see when they are investing in an early stage startup? Be it that a startup has a MVP ready, or they are at their ideation stage, they like the idea, or they have established a product market fit. At what stage do you think the angel investor starts investing?
got it. Now, see, you have to look at first fundamental principle that any angel investor is investing today, but the returns are there 3 to 5 years later. So whatever factors I'm looking today, I have to look at it from a time horizon of 3 to 5 years. How will that factors materialize over time? So the first and the foremost important factor becomes team, because that is the only tangible thing you have in front of you, right? So when you look at a team, you look at basically what is the founder's background. Is there a founder market fit where whatever founder is trying to build, is he or she the right person in that market to build that very same product or service? So that becomes the team's vision. And second thing that is more importantly, I have realized over time, is the founder's ability to stitch together a team, right? Even if the founder is, let's say, that the highest, like the most intellectual person you'll find ever on universe, but if their ability is not proven of building solid teams or building the right culture so they can retain a good quality team, then everything goes for a toss, right? So team is the foremost important factor. The founder is the foremost important stigma over there. The second thing is for us is the timing of the idea, right? So timing is extremely important, because if you are an early player in a late market, you will not be able to reap the results. If you are an early player in an early market, you would also, the time horizon would be too much. You may not become that big in 3 years. It would take 10 or 12 years, and the angel would not have time to block his or her capital for 10, 12 years. So you have to be an early product in a growing market, right? It should not be very early, too ahead of its time. Like we look at technologies like Hyperloop, or we look at technologies like AI, generative AI technologies. These are right now in progressive stage, bit ahead of its time, right? So you should be rightly, and again, let's say if you talk about e-commerce, now there are plenty of players out there. So you may not be the early player in a early market, because there are already people who have taken first, second, third mover advantages easily on that. So you should be early player in a growing market, right? And the trends should support that. So for example, EV is a perfect example, right? A lot of people who started in EV, we made our first investments in EV. I personally as well made a lot of investments in EV. The market was growing and the trends also supported it, with the flame policy coming in, or with Delhi government announcing that, or in the central government announcing that in the 5 years they want to automate every car on the road to an electric vehicle. The trends also support that. So whatever the growth of the industry is, the government, the industry, the academy, everyone has to support the growth. So timing is extremely important. You have to evaluate different trends. You have to look at patterns, and you have to see whether this can be an actual fit in the next 3 or 5 years. And again, this is a ballpark that you're taking. Nothing is that finite. And third, and the most factor that becomes important for us is the 10x potential, right? Even after looking at team, even after looking at trends, I have to analyze that what am I getting at the end of the day? Will I get, even let's say all the assumptions that I'm making on the growth, let's say all of them turn out to be true. What is the value that company can get in that same market? Can it be a 5x? Can it be a 6x? Can it be a 7x? I say at least it has to be 10x, because if it is not 10x, right, you're actually not making returns. if you look at time value of money, if you look at concepts like tax that will be taken out, because angel investments are taxed almost upwards of 30% in this country, right? So if you look at all of that, right, your returns have to be in sync with the time duration through which you have invested. So at least a 10-time returns has to be there. If a company is not doing 10x, it's not a start to your business.
Right. So you briefly talked about what are the risk and returns involved while answering the evaluation part of it. Can you explain us in detail as to, it is seed investing or angel investing is a AIF form of investment, which comes under the alternative investment part. So it is much riskier than the normal debt or the equity investment that a normal HNI would do. So the risks involved in it is also the rewards, like you are saying that 10x that we would not get if we were parking our funds in a FD or something like that.
Got it. So see, typically risk and returns, like that is how the principle of finance works anywhere. If it's a high risky asset, there will be a commensurate high returns on it as well. You look at assets like cryptocurrency also, right? These are high risk assets, but if done well, these have given 300, 400 times, even 5,000 times returns to the early investors. People who were the earlier investors in Bitcoin have made a fortune, right? In 2010, they've made a fortune. Of course, now market goes up and down. The equity market is also down. So is the crypto market, right? So that goes up and down. But essentially in a high risk category, there has to be high return. That is when angel investments, we say two things primarily. One is, don't put more than 5% of your total net worth into more than that into angel investment, because it's a more than high risk. It's an illiquid asset class. Even if the company is not doing well, you can't take a loss on it. You have to wait for the company to go through a slump sale or to go through a closure or through a winding up, and then you have to carry forward your losses, right? Irrespective of other of that, a stock market is liquid because you can just sell your share at loss or sell your share at profit to someone else. Even if you're making profit in a startup, you will have to wait for the other buyer, or you will have to wait, let's say, somebody on the other side who can buy that share from you. And since these are unlisted companies, they're highly liquid, right? So liquidity and high risk, that's why I say more than 5% of your net worth should not be invested. And this should be the money that you are okay to leave, right? It's not that you are expecting that this money turns out to be 100x. Otherwise, if it does not, I'll cry a river, right? You should not look at investments from that. This is the money that you should be able to lose. Even if it becomes zero, it should not pinch your pocket or pinch your bank accounts tomorrow, right? So have that excess capital and then invest that excess capital of angel investing. Don't invest your salaries into angel investing, right? And the second aspect is diversify, right? Typically what I've seen is, and this has been proven over research as well, average portfolio size in an angel investment should at least be 20 or 25, because below that, it does not make sense. Let's say if you're investing in about 15 companies, right? About 30-40% of your companies would not even see the day, even more than that sometimes. But I'm taking an estimate that 40-50%, let's say, will not succeed, will not give you that return. 20-30% would just give you the principal return back, right? Then there will be 10% companies will give you a 3x, 5x, 6x, not a 10x maybe, right? And then there'll be at least that one or two company that will give you that 10x, more than 10x return, maybe 100x. If it becomes a unicorn, maybe 1000x, right? So essentially diversify, because that one company which gives you that unicorn level return covers the portfolio, covers the losses of all the other portfolio, right? So diversify, invest in at least 20 companies, right? And then also don't invest more than 5% of your net worth into this.
Okay. So when you say that you invest in 20-25 companies, what is the typical check size that an angel investor usually puts in a company?
See, earlier when angel investments started, for a lot of time, angel investments were starting with at least 5 lakh rupees, right? The earliest angel investment seen in India, which started from 2008 to 2009, most of it did 5 lakhs. Even when we at FAAD built this network, 2019, we started for good 1.5 years, we started doing it 5 lakhs. Then the transformation came in, AIF structure came in, SEBI introduced angel fund category for the first time. And check sizes, it started reducing to 1.5 lakhs, 2 lakhs, 2.5 lakhs. So anywhere that also. But I at least suggest that if you have to invest, at least 2.5 lakhs should be invested. Because if you're just investing at least a lakh, right? The thing is that even if it goes a lot of upside, the return may not be too much because the base is smaller. So if your capital is multiplying, the ideal financial principle says that make your base bigger so that the return multiple is larger. But if you're investing 1 lakh or 1.5 lakhs, it becomes a bit tough. However, what I say is follow a smart strategy, right? Maybe invest a lower, don't invest 3 lakhs all at once. Start investing maybe 1.5 to begin with in the first round. If you think there is a winner out there, a company is doing well, then maybe double down your investment later. If the company is not doing well, then maybe don't do your further investments, right? Don't exercise your further and stop at that, right? So that's how you smartly prioritize your companies, but always reserve some capital for winners, right? Because if a company is doing well, you would want to take added advantage of it so that you can at least cover the losses if the other companies don't do well at the other days.
We also talked about illiquid investment, like this being a illiquid class of investment. So what do you say would be a ideal exit scenario? How does an angel investor get an exit from a startup, and what are the routes available for exit?
Got it. See, primarily in business books, there are mostly 4 to 5 stages of exit, but I'll not go much towards explaining that. I would typically explain the 2 or 3 types of exits that I've generally seen in startups over time. The first exit that typically happens, and India is a growing M&A market, right? Hardly 1% of the startups have actually executed on the ground exits, have given exits. US, for that matter, is much more mature than us. Typically in India, I've seen 2 types of exits happening. One is, I think, the secondary exit, where basically your share is being bought by the incoming investor, maybe a VC, right? Maybe a large family office, maybe a high net worth individual, anybody who's coming in the round after you. Go back to that same example, right? Anybody who's coming at the round where your tree has gone by 2 or 3 times from the ground, right? So anybody who's coming maybe at that point of time, or anybody who's coming when it's going towards a tree, right, typically would buy your share, right, and give you that exit, right? So this is one form of exit. Second form of exits that India lately has seen is a lot of companies going IPO, right? In IPO, typically, of course, you've seen Zomato, Nykaa, Paytm, right? All these companies going for an IPO. Now, typically in IPO, there is a thing called as an offer for sale, where in existing investors, along with maybe some founders as well, would like tie up their shares and offer it for sale for public investors to buy their shares. But typically for angel investors, this may not be a viable strategy because by the time a company goes IPO, you would not actually be on the company. You would have get a secondary buyout before, because VCs need higher portion of shareholding, right, to work out the maths. So they can't buy it from founder, because if the founder gets diluted, the company goes for the management goes for it. So they buy it from the other investors. So secondary has been the most preferred choice for exits in India. But apart from that, there is, in theoretical terms, there is founders buyback as well, where founders buy your share, or a strategic sale, right, where you basically sell out your company, or a strategic buyout, right, or a carve out even, right, where you set up a subsidiary and the subsidiary ends up getting the parent company. In theoretical terms, there are more exit options, but these are 1 or 2 major things that I've seen for investors.
And what is a typical timeline for exit?
So what I think is, for early stage investors, the ideal duration may be anywhere from 3 to 5 years of from the date of investment. That's what the typical timeline is.
Right. And so how do you get a deal source when you're starting your angel investment journey? What is the major deal source of startups? How does an angel investor go about it? There are angel networks, there can be incubators, accelerators. How do they go about it?
Yeah, I think, yes, Rucha, you listed out some of the ways in which, like some of the major ways in which you get deals. So one is, of course, networks like us, right? People become a part of the network because they can get access to high quality deals, right? People who don't have time, because sourcing is also a job, right? You have to spend time. You can't expect that just deals will come in naturally to you the moment you announce or write angel investor in your bio, right? It does not happen like that way. So it's as much as founders have to push, investors also have to push for good deals, right? So it's both ways. So one way is, as Rucha said, is to join angel networks, funds like us, right, and others out there as well. Not promoting anyone, but everybody out there who's getting deals, right, who's sourcing deals, and who's also vetting the deals on a first level. So that sourcing plus vetting is happening on the same day, and you are basically, your efforts are reduced, right? Second way is, I think, referrals, right? Referrals can come in from two ways. It can be from your investors. So that's why I say, as an angel investor, you are in the network, or you are in the business of networking. So you have to network with founders, you have to network with investors, and that also helps you to learn from their investing side, while also helps you build a relationship. So let's say I'm an angel investor, Rucha is an angel investor. I have got a deal and I want to invest in that. And let's say there's a space for two more investors. I send it to Rucha, right? And Rucha also makes a plan to invest in it. So for her, I become a sourcing partner or a channel partner for that deal. So yes, referrals also play an important role. And for Rucha, the thing is that if it's coming from my side, that will also help her in first level layer of filtration and at least getting to a more informed decision. So referrals, and founders can also refer, right? So let's say now in this case, let's say I am a founder, right? And I want to raise, right? I look at what are the angel investors, and I look at, let's say Rucha is actively investing. So I reach out to her, right? So you also get founder referrals, right? And let's say I'm a founder, Rucha is also founder, and let's say somebody else is an investor. So I already have that investor who's invested in me. So I talk to Rucha and say that you can talk to this investor. So founder also refer investors to each other. So that's how you work.
Right. I think we have already discussed about the evaluation part, but say that we get a lot of deal inflow. How do you identify that one unicorn startup out of the entire lot? How do you go about that?
I wish I had known the answer, the exact answer for it. I would have definitely been a billionaire by now. But there's no one way to actually look at unicorn, right? There's no one formula. There's nothing else. It's more of angel investing is also gut feeling, right? Let's estimate with that, because practically you, after doing all the research and evaluation also, right, you are investing in a company which practically can go down to zero in the next 3 years also, right? One small regulation, right? Founders fight between each other, right? Multiple reasons of failure that can happen, right? You could not even have predicted, right? Company has a legal case 2 years down the line. Anything can happen, right? So practically it's impossible to be a god, right? And look at future. But what you can look at is, I think, a rock star founder is what I've looked at. I asked the founder just 2 questions, and that gives him a lot of clarity. The first question is, I asked the founder, how will you make money for the investors, right? Because this question then gives me a leverage on whether the founder wants to work with me or not. Because even if that becomes a unicorn tomorrow, but that founder does not want to work with me for longer, I may not maximize on my returns, right? So I firstly asked this question to see whether the founder is investor friendly also, right? So I need to look at, that's a very important metric, that I need to look at whether the founder is investor friendly, wants to work with investors, respects the investors, whatever advice maybe they are giving. I'm not saying blindly follow it, but at least discusses them or takes them with some seriousness or listens them with some patience, right? So my first question is that. And my second question is, what is the bigger vision, right? For me, it's all about that. If the founder does not dream big, even if they are in a bigger market, they can't become number one, right? You have to dream big. You have to look beyond what the ordinary is. And that's the only way you can go to a unicorn, right? Companies, if you don't think you will become unicorn on day 0, how would you actually become a unicorn on day 365? So that's that.
Right. So when an angel investor enters on the cap table, what do you think? What is an ideal dilution that a founder should do? The entire syndicate, the entire angel round, because if you invest, usually angel investors get very greedy and ask for more, but if a founder is diluted more, then it becomes very difficult for them to raise a further round. So what is the ideal dilution that should be looked at?
Got it. I think that's a great question. So I think the first thing you answered yourself, you should not be greedy when you are looking at angel investment, because if you get a higher percentage, that typically means nothing, because if the company has diluted a lot, for another VC would not have interest, would ask this question that why should I invest in this founder who does not hold enough equity in the company, right? I am not investing in the angel investor. I am investing in the founder, right? So essentially that becomes extremely, extremely important that you look at the right number. And even if you take a larger percentage, right? Practically 70% of zero is also zero, right? So essentially that does not mean anything. So what ideally I've seen is, and this also varies depending on companies to company, industry to industry, every industry has a different number that goes around for valuation. But 5 to 25% at max is what I've seen in companies diluting in angel rounds. If you're diluting more than 25, then it's a bit harder to get equities at later stages, right? Because the value of equity would grow up, right? And giving a larger share, giving a larger exit to investors, right, would be a bit tough to gather that much cash. So between 5, starting from 5, as low as 5 to 25% is what I've seen. You don't want to go less than 5 as well, because that would hardly leave any angel investor with equity. How will they be incentivized to help you? If an angel investor is holding 0.1%, 0.2%, 0.3% in your company, do you expect them to wake up every single day, take out their time from their busy schedules and help you, right? They may not prioritize this above their daily tasks, because angel investors are not full-time investors also, right? So they have got their own jobs. Sometimes they have got their own businesses. They are founders also. So there are different classes of angel investors. So they may not help you. So start at least with 5 and go all the way to 25. But average is somewhere between 10 to 15, 20, 16% that I've seen.
Okay. And what are the forms? Is it direct equity, CCPS, convertible notes? What is the ideal?
See, angel investing has to convert into equity, right? Somewhere down the line, it has to convert in equity. But to start with, it can be multiple. It can be equity, right? Where it's let's say a CCPS convertible. Let's say then there is a CCD, compulsory convertible debentures, which are also a form of debt, right? So they have as low as a 0.001% interest rate, but they are a debt, and they convert it at a later stage into equity based on the future round, right? So I'll not go into depth of explaining what a CCD actually, how it converts. But there is CCD, then there is equity as well, which of course is a price round. This valuation in this much you are raising, that's your equity round. And then of course there is grants as well, right? Which also fall under the purview of angel investments. Some of these are equity linked grants, right? So some of them are equity free grants, which are out there. Which basically does not have a dilution towards it. They are just donation or a grant that's given to the founder. So typically I've seen these three ways only of raising. Equity crowdfunding, for that matter, is still not legal in India. So yeah, that is.
What are the rights that an angel investor gets when they enter the cap table? Be it information right or any other right. I think at an early stage, they might not have many rights, but basic rights that they would get.
I think while they're like SHA is a huge document, neither I'm a legal expert also to cover all the rights in legal language, but I'll typically lay out 3 or 4 major rights that you as an investor, if you are starting an angel investing journey, should know. One, Rucha said herself, is the information right. So once you've made the investment, after that, the company sends you regular updates, right? In the form of quarterly reports, in the form of, let's say, monthly newsletters or whatever, right? That may be agreed upon at the time of investing between the investor and the startup. So you have the access to that information, right? So you know how a company is doing. And if at any point of time, if a company you think is not doing well, you also have in that right, you also have a right to audit the company, or you maybe go to the company's office giving an advance day's notice also. So you should know these rights. So that ऐसे rights angel investment के होते हैं कि if the company is doing well, nobody looks at that. But if the company is not doing well, you should know what your rights are, right? So that you can go ahead and claim them. So that is key information, right? You should have. Then second is a pro rata right, which is a very, very important, which is a preemptive right. So basically, if a company raises future rounds of fundraising, it firstly comes, let's say, comes to the existing investor seeing that we are raising this much round. So also called as the right of first refusal or the ROFR. right? So existing investors have the right of the first refusal. And typically, if they want to top up, they top up. If they don't want, they can, of course, not continue to invest. This is where, if you don't know this right, you will not be able to invest in your winners, what I said. You should know your pro rata rights and you should invest in that. So sometimes you can do a pro rata, which is, let's say, what jitna aapka dilute hua hai, whatever that max is working out to be, you can continue your shareholding. So if you had 5%, you can continue it across rounds. If, let's say, sometimes company allows you super pro rata as well at an early stage to angel investors, it allows you to double your investment or triple or whatever money you want to put in, of course, depending upon company to company. So if, let's say, you invested 1 lakh, now you can invest 3 lakhs also, right? You can invest 4 lakhs also. You can triple down, quadruple down, whatever, right? Your investment in winners. That's a super pro rata. If a company does not, in later stages, company does not give you this right because it results in excessive dilution. So there you can access your pro rata if you want. That is second. And I think the third right that you all should know is a liquidation preference, right? This I'll not go into depth of training. This is an exit right. So basically, this allows you, when a company is going down, it allows you to participate in a liquidation preference event. So let's say if a company is getting down for 100, the distributions of liquidation would be on such a way that, let's say, the first investor get 1 time their capital. Some investors have a 2 times their capital also. So if a company is winding down, they still make 2 times their capital, right? So essentially, this is how the liquidation preference also works out. A typical right in this is a 1x participating. This allows you to retain your principal, right? At least make returns, and also allows you to participate in the liquidation events of the company.
I think we have pretty much covered the entire spectrum. I'll just ask one more question and then maybe we can open to the audience. What do you think are the don'ts of angel investments? Do's we understand, don'ts, or you can say one mistake that you made while you started your angel investment journey, so that we can learn from your experience.
Got it. No, although seeing my portfolio is extremely young, so I'll make sure I'll realize of my mistakes in another 2.5 years, what mistakes I did. But I think one thing that I consciously now try is to not have FOMO, right? So fear of missing out in this industry is a crime, because I realized we are putting money in founders and everybody is a friend, right? Why not invest in them? Why am I being too analytical or greedy? Why not just invest in people? But the thing is that after some point of time, as you grow your journey as an angel investor, you would have everybody. It's a very small startup ecosystem, right? Let's understand this first. Everybody practically knows everybody, right? At the later stage. So everybody will be your friend later on, right? If you're growing well. So you should not actually have FOMO and do your own research before investing in the company. If, let's say, there are investors who are investing in that startup, right? And the round is almost closed, you would have the urge ki it's already valued by so many people, let me invest. But that may not be true, right? So invest in companies where you feel confident as an investor that they'll have a position to grow, not when somebody else is telling you, or not when you see many people already validating it, right? So take your own decision. Every investor has a different risk appetite, right? Every investor has a different risk horizon, risk preferences. So do your own research and then only go ahead and invest. Don't have fear of missing out. It's okay if you're losing out on a good deal, it happens. I practically lost on so many good deals, right? I think that would be a separate 40 minutes discussion itself. The company that I missed out on and kind of went on to did well. But I think it's a continuous cycle, right? Good companies keep coming in. You just have to keep looking out and do your own research before investing.
Great. That's a great advice, I think, in this funding winter that we are in right now. So now we'll take few questions that are in the chat. Mr. Ravi Kumar Tiwari is asking, how do one look at write-offs in angel investment? And what is the general trend? What percentage of angel deals goes into write-off?
So again, as I said, Ravi, that typically 30-40% of companies I have seen which typically go into a write-off mode, right? They'll not survive, they'll get shut down, or they'll burn out their capital. XYZ reason could go down, right? So essentially, investors can typically carry off their losses against the gains, right? And that's been the general trend. So first 3 years of a company is extremely crucial. Let's say you have angel invested in a deal today. the first 3 to 4 years of that deal is very crucial, because if they're able to survive and grow in the first 3 to 4 years, the probability of going down becomes lesser. Company can go down at practically any point of time. We have seen many unicorns in China who became a unicorn within 6 months, they went down, right? From India as well. I would not like to take names, but in India as well, right? Many companies who became unicorns are now struggling due to XYZ issues, right? So essentially, yes, first 3 years are critical. You'll get the answer whether I should write it off or.
Mrs. Angul is asking, Mr. Shyam is actually asking that how much should you invest in a friends and family round before the angel investment round?
Okay, so I think his question is two ways: how much to ask while investing as friend and family, and how much should I put in? See, again, that depends. There is no one fixed number to it. Typically, in friends and family, we say angel investment are anywhere raising from, let's say, a 500,000. This is I'm talking about in Indian context. Anywhere raising from 500,000 to 5 million is an angel investment check. Beyond $5 million, a larger VC would come in at a series, right? Again, this is a broader trend. Companies can also raise a series A, which is $4 million also, right? There is no one definition to it, right? The best part about that is that. So friends and family, anywhere starting from as low as, let's say, 30, 40, 50 lakhs, going all the way to at least 500,000, 3.5 crores is what I've seen. Friends and family rounds typically raising, right? If you have more friends and family, you can also raise $1 million, right? So it all depends on the friends, family, the connections, and the level of investment that they can make, the financial worthiness they have. And how much should you put in as an FNF? This also depends. See, in friends and family, there is no one lead investor, right? That's why in lead investor typically comes in at an angel investor who's putting a larger check. Let's say 3 crore per round and an angel investor is putting in 1.5, 2 crores, that becomes a lead investor. But in friends and family, there are no leads, because you don't want to raise a lot from just one friend. And friend would not be able to add value. You're just putting in because you are a friend, right? So typically whatever the others are contributing it, plus depending upon the love that you have for that friend, right? Evaluate that and put according.
Yeah. Hi, myself Bhargav Ram.
Hi, Bhargav.
I'm a cricket mentor and administrator. I mentor international and IPL cricketers, and I mentor a few startups in cricket industry. So I plan to start a startup studio specifically to mentor and invest in startups and businesses in cricket industry, building exclusive network of investors for cricket. So what is your opinion about startup studios and their role in growth of startups, like from incubation to scaling them? Thank you.
I think Bhargav, rather than being an angel investor, I could be your first customer also, because I am also a professional cricket player. I played for my state Delhi in under 19. But typically, see, startup studio model in India has not picked up, as of course it's borrowed from the US, right? With companies like Y Combinator and all those who've done it at large scale effectively. But yes, startup studios are definitely coming up, right? But the thing is that to aggregate all of it and to do it at a same quality and do it at the same subject matter knowledge becomes a bit tough, because startups in India require 10 different things. When we also started at FAAD, we started out on a startup studio model, but we realized that startup founders require X number of things, and there are only certain ways in which you can help them. You can't be a master of everything. So we picked up fundraising, and that's how the fund came into existence. So be very, very specific as to what the role of the startup studio is. Then also maybe I think partner up with organizations like Headstart, right? Who basically help you get the right level of investors, entrepreneurs, good, extremely growing community, and one of the largest out there in India, right? So essentially in plugins or incubators or partners like these also help you to sort of get good quality entrepreneurs, and then have a focus, have a larger vision. What do you want to do with the startup? Because we create a supply side of it, but demand side of it, we didn't see whether the people actually need it or not. So work out a plan on how this will be different, what actual value you will provide, grow accordingly.
Sure. So I would love to connect with you in person.
Perfect.
I'll text you on LinkedIn. Thank you.
Thank you, Bhargav. does the group, the other angel investors who are coming in, does their profile also make an impact? Do you think the co-investors have an impact when when a startup is raising a investing ground?
I think yes, to a lot of extent, yes, it is there. Because if let's say that investor specifically is investing heavily in that industry, right, or is already a master of the industry, has invested in good 3-4 deals in that industry which have gone ahead and done well. If they're an investor investing, that helps a lot, right, to add to the confidence of yours, right? So yes, it does help. But as I said, right, a prudent investor, right, after some point of time would stop looking at the name and would look at the logic, right, that why they are investing. So yes, it does help me get to that first, second, third level. But while I am investing, while I'm putting that final check, I would look at why they are investing rather than who is investing, because name is immaterial to investments, right? If a company goes bad, it does not go bad for one name, or it's not name agnostic, right? It's name agnostic actually, so it can go bad for any.
Right. Also, are there any red flags that you see when you are investing, when you, like you see that everything is good, everything, or the founder is good, the idea is good, the product is good, but still there are some legal or financial problems that you see? How to identify that before you make the wrong investment?
Yeah, I think that's another banger of a question. Typically, that's why you say diligence is very important, right? Whenever you're doing it, one is the one which your legal, taxation, and everything that happens, right? Which is the standard process, right? After that, only you go ahead and invest in a company, right? So, but before that, also you have to do your own level of founder due diligence. Take reference checks of the founder. And this has to be done in secret, right? You don't have to go to the founder yourself and ask for connects. This has to be done so that the founder is not aware of course, and that does not brings in biasness also. So typically you can either do a reference check of their previous employer, right? What has been their experience. You can sometimes do a reference check with their colleges as well, because if they are a student, young entrepreneur, you typically do a reference check from the college that they are coming from. And there can be reference checks of the clients that they've served in the past, right? So if it's a consulting person, or if it's a auditor or someone, right? So also do a reference check from the clients that they've served in the past. This is all to be done under the radar, under the carpet. That's why I say, even if everything looks good, right? We have a saying in angel investment: if everything is looking good, something is going bad, right? So that's why it should not be too good to be true. Also, case kind of a scenario. So that's why do your proper due diligence, and then only go ahead and invest in a company. Even if it means that you will lose out on time on investing in a company, but if you haven't done your due diligence, I would say it's okay to lose out on a good deal, but not to invest in a bad.
And after an angel investor has made the investment, how involved do you think an angel investor should be in day-to-day operation of a startup? How to monitor? What should they look in the MIS? How do you go about that?
Yeah. So see, in angel investment is, again, as I said, it's not a job, right? It's not that you are a spoon feeder of the founder 24/7. You have got your own business to take care of also, or your own job, or whatever you're doing, whatever background you come from. So you don't have to be with the founder 24/7. You have to give the founder breathing space and also execution space, so that whatever maybe advice you are giving, at least they have time to implement that, right? Because if you're just talking day and day, you are giving mentoring and advice, right? So too many cooks spoil the brew. That's the common saying, right? Essentially, handhold in the right direction. Every time when you are discussing, set metrics that this is what, let's say, you want to achieve in the next 3 or 6 months, and then look at the targets. So if let's say the first 3-month target is that my revenue, that my business should become, let's say, GMV from 6 crores to 20 crores, then look at purely the GMV growth. Don't look at burn. Let's say after the 3 months, my target is to reduce my burn, so that I can move towards profitability. Then look at burn. Don't look at GMV growth that much. So every time when you're sitting with the investor, with a founder, discuss the metrics that you want to discuss for the next meeting. Evaluate the business. Also get founder's perspective that this is the metric they want to focus on for the next 3 months. And then in the MIS also observe similar metrics. And if you are not achieving that, then ask in your quarterly meetings, on your regular meetings, that why is this not happening? What is stopping them? I think this kind of mentorship is the best, where the other person is also aware that where am I stuck? And it's very, very specific going to the problem that I have right now, not to the problem that may arrive in the future.
And what would you say that when a startup is looking out for an angel investor, do they also have a preference? Do they also, ask you that what you are bringing onto our table and what are your deliverables apart from the funding, of course?
Yep, I think great. So as I said, as much as our job is to look at startups' job is also to look at us. So as there is a thing called founder due diligence, there's also a thing called investor due diligence, right? Where basically you talk to the portfolio companies of the angel investor, that how are they contributing there, right? How much time are they giving there, right? What value add they are bringing, what connects they are having. Then you also take you also talk to your fellow investors, because as I said, angel investment startup investment is a very small market in India. Everybody knows everybody, right? So you can practically talk to your co-investor as well, right? They might be knowing me or whoever is investing the other person, right? And you can take a feedback from there. But typically startups want angel investors who are founder friendly, also, who don't put too much targets, right? And who also, again, as I said, give the breathing space to startups to do well, and also understand if the companies are missing targets. Maybe I'm not saying when they're blatantly missing targets, but if for some reasons they are missing it, then also support them, because entrepreneurship is a very lonely journey, right? So in angel investor, I also seek a support who can help me at least get to a safe path, or at least help me get to a navigated path. So yeah, you can take a feedback, and good founders end up taking two. But at some point of time, it kind of becomes immaterial also. Let's say personally for me now, in founders, as per my knowledge, right, haven't taken investor due diligence, because once your name goes in the industry, typically people don't waste time in talking, okay, who that other investor is.
And just one last question. Say, for example, a startup is raising 1 CR and you yourself have that amount of capital that you want to invest. Do you think it's a good idea to go in alone, or do you think that syndication would work best?
See, my personal opinion is a bit biased in this. My opinion is that you should not go alone at all, because investments are all about diversifying the risk and hedging the risk also. Let's say, even if you are an expert in that field, right, you might not be 24/7 available also. Right, you might not have that much time to contribute also, right? Forget about 24/7 availability. You may not have time to contribute to a startup. You are running your own business, which is at a growing stage. Second is, even if let's say you have time, the thing is, it's just a one perspective that will be given to the company. It's always good to have multiple perspectives, because I may look at the startup from a different view. The other person who's a tech background focused person would look at it from a different view. The other person who's a marketing focused person would look at it from a different view. So don't invest all alone. Have multiple people join your cap table and invest with you. Unless and until you are, of course, some big entrepreneur, unicorn founder who says that I'll do it all, then it can make sense. But typically, I haven't seen, it's not a good strategy also, because then you are laying all your eggs in one basket, right? So have that diversity of opinions, and also the diversity of capital with the other person coming.
Great. Fine, I think we can close this session. Thank you so much, Aditya, for giving your time. This was a wonderful session, and I'm sure all the attendees had a great time and they got to learn a lot from you. Lastly, I would just say that at Headstart Investor Circle, we do such sessions every month, and you can join our community. And yeah, that's it. Thank you so much, guys. And thank you, Aditya, for joining in and giving your time.
Thank you so much, Rucha and Team Headstart, for this. Thank you, guys. I hope you like the session.